Why are mortgage rates rising even when inflation seems to be under control? Is this a temporary blip, or is this just a sign of more serious things to come? If you're eyeing a move to the Boise real estate markets, you'll want to stick around, because this week was a reality check, and next week could deliver even more surprises. Hey, I'm Mike Petras with MPRE Boise, powered by Next Home Treasure Valley, and welcome to another mortgage update to where I go ahead and break down what happened in the week with the rates, so you can make informed decisions whether or not you're shopping in Boise, Meridian, Eagle, Kuna, Star, Middleton, Caldwell, Nampa, and Emmett. But before we dive in, please give me a like. Also, if you like this content, please hit the subscribe button below, hit the notification bell so that you're constantly tuned with the content that I do come up with, and feel free to share this with anybody that you might feel could find it useful. And of course, if you are looking to relocate right here to the greater Boise, Idaho area, please feel free to click below in the description, download my free relocation guide. It's full of resources that will help you determine which area here in the Treasure Valley will suit your lifestyle the best. Of course, you can also just scan the QR code right over here to my left, and trust me, I know you'll find it useful. So let's get into what happened this week. Well, it's been a slow, subtle burn in higher rates this week. We started out Monday with rates ticking up to 6.76%, thanks to weak bond performance driven by upbeat economic news, specifically stronger than expected S&P Services PMI data. And on Tuesday, despite overnight bond selling, we saw a midday rally that nudged rates back down to about 6.74%. Wednesday and Thursday brought minimal day-to-day change, but the net movement was still slightly higher, and then finally 6.78% respectively. But on Friday, finally, despite the hotter than expected PCE inflation report, bonds brought a small rally, helping rates settle slightly lower to around 6.76% to close out the week. So yes, we ended the week right about where we started, but not before taking a slow climb towards the highest levels in over a month. So why did the rates move like they did this week? Well, it all started on Monday with what we call risk on energy. Investors reacting positively to news of expanded tariff exclusions. Stocks rallied, bonds sold off, and that pushed rates higher. Then came Tuesday's consumer confidence numbers, the lowest since July of 2022. That usually sparks concern in bond buying, which is exactly what we saw, leading to a temporary rate dip. Wednesday gave us durable goods orders that were stronger than expected, another reason for markets to pump the brakes on optimism about rate cuts. And then Thursday's job data, the Q4 GDP revisions and jobless claims were mostly as expected. But it wasn't really until we got to Friday that things kind of got interesting. And that's when we saw the PCE inflation report, as mentioned in last week's mortgage update. This is the Fed's preferred inflation gauge, and it came in slightly hotter than forecast. But the bond market barely flinched. And why was that? Well, it's because the numbers were close to expectations, and some traders were likely just relieved that it wasn't worse. So based upon this, what is coming next? Should you lock in or should you wait going into next week? Well, the market's still stuck in a sideways grind. And while volatility was minimal this week, the consistent upward pressure on rates shouldn't be ignored. If you're under contract and numbers still work, this is not the time to gamble. Locking in now makes a lot of sense. But if you're still in the early stages and have some room to float, there's potential for better pricing if upcoming economic data disappoints. Either way, we're sitting at the highest mortgage rate levels since late February, and the market is clearly hunting for another catalyst one way or the other. And what to watch out for next week closes out Q1. And while the calendar is looking lighter than this week, we still have some market moving potential. Monday and Tuesday will be quiet, but Wednesday brings the ADP private payroll report, which markets often view as a preview of Friday's big non-farm payrolls number. Thursday brings jobless claims again, and Friday wraps it all up with the March jobs report. If wage growth is strong or job creation beats expectations, it could keep pressure on rates. But if we see labor markets soften, that might finally let rates ease a bit more. And as always, the bond market, and therefore mortgage interest rates, live and die by the data. While this week proved once again that rates just don't follow inflation, they follow momentum, psychology, and even headlines about tariffs. The bond market is looking for direction, and it's going to take some strong data or a strong miss to break the sideways pattern. So what's your take? Are we heading higher into April, or is the market just catching its breath? Drop a comment below and let me know what you think. And remember, hit that like button if you enjoyed this content, hit the subscribe button and hit the notification bell so that you're constantly in tune with these weekly mortgage updates. And please feel free to share this video with anybody that you know that could benefit from it. This helps them and you stay on top of the mortgage market. And if you're buying or selling in Boise, I've got your back. And also, if you're relocating to Oregon, Washington, California, Nevada, Arizona, Tennessee, or Florida, I'll connect you with a trusted loan officer to be able to help you make that move. Let's talk. Well, thanks again for watching, everybody. I'll see you next week for another mortgage rate update. God bless. And I look forward to the day that I call you my neighbor.